Today's show is a tale of two forecasts. You'll get this one from Paul Christopher, head of global investment strategy at the Wells Fargo Investment Institute.
We are expecting a pullback. There will be surprises. Some of them will be negative, and we think the S&P pulls back 5 to 10% easily from here. Not like back in April when tariffs were a surprise. This time they're not a surprise, but they will be coming, and they're going to generate inflation in the third quarter. That inflation then will slow the economy further into the end of the year before we start to pick up momentum again in 26.
But you'll also hear this from Matt Fox, president at Ithaca Wealth Management.
For the S&P 500, I could give you a target, and it's about 7,000 over the next 12 months, which is almost 20% upside from current levels, and I'm feeling pretty confident about that.
If disagreement makes a market, those conversations are
very interesting.
Oh, yeah. Plus, we've got Drake Shadwell, analyst at Clever Real Estate, here discussing their research on how long it's taking right now to sell a house.
Let's go out. We make some money. I got bills to pay.
Welcome to Money Life for June the 17th. I'm your host, Chuck Jaffe, and yeah, we have a great show planned and executed for you today. And yes, it's going to go in different directions because you've got two, they're not completely diametrically opposed forecasts, but they do not see the rest of this year remotely the same. So that is always interesting. And while Matt Fox is here to talk technicals, that's the segment he is joining us for, and he will be talking technicals. He is one of those technical analysts who splits his view. It's not just the technicals. It's like 50-50 technicals and fundamentals. And so when he's saying, this is what I see for the S&P and I see it going up, he makes the point in this interview. I'll play this clip for you. Things are set up to go well in part because things have not necessarily gone as well as folks would like.
You know, we already did a lot of the technical damage that needed to be done in order for the market to grind higher. And that was a near 20% sell-off earlier this year. So I feel like after that much damage, with enough time of us kind of going sideways and consolidating these recent gains, the path of least resistance is going to be higher, no doubt in my mind.
And then the flip side of that, and I'll pull this forward too, this clip from Paul Christopher about his worry about people getting too happy with what's happening right now.
What we're afraid of is that the more we rally here, the more people will be clamoring to get into a market that is going to turn around, and that those folks will then end up being some of the first to exit. And what that does is create an accelerant to the downside. In other words, the more people who pile in here at the very end of the rally, the more likely it is that the market, when it does turn, will fall furiously and fast.
So you've got a lot to listen to on today's show, all of that in those interviews. The order of them is not as we played them. It is Matt Fox first, then Drake Shadwell from Clever Real Estate. You know, what's happening in the housing market, it's real. You're seeing it empirically that houses and what's on the market is slowing down. And Gail and I are trying to decide what we're going to be doing moving forward, but we're very much watching houses both in our neighborhood are now suddenly staying on the market much longer. Houses in our neighborhood normally on the market for like less than a day. And I know that seems impossible, but the last two houses that sold on my street were sold technically before they went on the market. They were planning to hold the open house, put them on the market, and a real estate agent showed them to someone who was shopping for a home and said, well, this is going on the market. They said, can we see it right now and try to preempt it? And then they did preempt it. And one of those houses was only available because somebody who was one of my neighbors knew they needed to upsize. And they had walked through the neighborhood and they knew that there was a woman of about my age who had gone through a divorce, et cetera. She had the house. Her kids were now grown and she was deciding what she was going to do. And they said, hey, when you are ready to sell, we would love to buy. And that's what they did. So that house was never even on the market. And now there are a couple houses on the market that are not selling. Now, they may not be the best houses on the market or whatever. You can never tell for those sorts of things. But when you see it in your own neighborhood, and I am not suggesting my neighborhood is proxy for the entire country, because that is distinctly not the case. But one of the things that Gail and I have noticed as we've looked at other things is that, like, we're busy. If we get a chance and we're out doing some errands, we may stop and look at some open houses on a weekend or whatever. And We had one that we were hoping to get to that we couldn't a few weeks ago. And this past weekend, as we're planning our day, we're like, ooh, we could go by that. It's still on the market. And we were surprised it was still there. So we are seeing some things that are having that happen. And that's an economic thing. So we'll have some discussions there. I'm Chuck Jaffe, financial columnist, your host here on Money Life. This show is independent personal finance talk. We are dedicated to looking smartly at a wide range of approaches and opinions on investing, so you shouldn't be surprised that you can have disagreement on what's going to happen in one show. This is not the lightest lifting that you're going to get out there, but it is going to help you gain the confidence to make the moves you need to make so that you can weather whatever these storms are. And by the way, they don't all have to be storms. They could be sunny days too. Write me, Chuck at moneylifeshow.com. Let me know what you're thinking, how I can help you, how we can make this show better. Tell us what you're hoping you get out of us. If there's questions you've got, all that kind of stuff. Again, Chuck at moneylifeshow.com. I want to point out there's a reason why I don't make market forecasts. Yesterday I said I expected the market to open down and then maybe rebound. It just opened up. Blew right past that. It was ready for that. Again, I don't keep score on those things because they're so fleeting and so transitory, but it's why I should never comment. So if you're watching the open yesterday, go, Chuck said it was going to go down. Yeah, sorry, got it wrong. That happens. I should just never say any of that stuff. In fact, I shouldn't say anything more because we had a great show. I've played you like extra clips from it. We should get into it. Matt Fox, Drake Shadwell, Paul Christopher. The talk starts next.
To navigate today's complex market, investors need accessible, quality research. VettaFi offers free webcasts from portfolio experts and industry leaders. Earn CE credits and take your portfolio to the next level. Go to etftrends.com/webcasts and learn more.
Don't get technical with me. But enough of my technical mumbo-jumbo. Allow me to demonstrate.
We start today's show talking technicals, and returning to the show to do that with me, Matt Fox. He is founder and president at Ithaca Wealth Management. If you want to learn more about him and the firm, ithacawealth.com. Matt Fox, it's great to have you back on Money Life.
Hey, Chuck, thanks for having me. Happy to be here.
So we've got a market that has rebounded sharply, but we're all waiting at this point for the next shoe to drop. And the next shoe would be, is it going to recapture record high levels? Do you think that we're getting there, or is it starting to look like record highs is going to be the next resistance level? And if we don't get it, we're going to fall back a bit.
I think it's right on target. New highs are coming soon. I feel pretty confident in saying that. I think the momentum has been strong, and we've seen a lot of great participation across sectors. It's not just a handful of stocks that has driven this rebound from the, April tariff lows. It's been the entire market. So I think that's a good sign that not only are we going to test those new highs, but we're actually going to keep on going up and keep on making new highs for the foreseeable future.
So you actually answered my next question there. We're going to keep making new highs for the foreseeable future. In other words, we're going to confirm that this is a real rally and that this can continue. That's without necessarily anything about the potential headline risks, or headline risks be damned, we're in a spot where we can keep running.
I think we're in a spot where we could keep on running. I think sentiment among investors, it's not as bad as it was in April with the tariffs, but it is still very depressed. And I think there's a lot of room for the market to keep moving higher and keep convincing these skeptical investors that, hey, you know what? Maybe we have some tariffs, maybe we don't, but they're not going to tank the economy, and we could get through that. The market persuading these skeptical investors that's going to take weeks, that's going to take months, and that's just going to lead to more and more buying pressure. So for the S&P 500, I could give you a target, and it's about 7,000 over the next 12 months, which is almost 20% upside from current levels. And I'm feeling pretty confident about that.
Wow. Because that puts you at the optimistic end of the folks we talk to. 7,000 is not a number that has come up a lot. Why are you so confident? I mean, what are the things that you are looking at that you're seeing? And I know you pay enough attention to the other guys to know that they're not there. So what is it that you see?
I think it's on the fundamental side. The big picture, the big story is the AI. And I don't think people are fully grasping how big of an impact that's going to have on company earnings across various sectors. It's a multi-year story, and we're in year 3. So it's still very early innings for that to play out. We're just starting to see the IPO market open up with enthusiasm. We have that depressed sentiment. And then on the technical side, let me tell you something interesting. The April tariff sell-off was about 1,200 points in the S&P 500. The sell-off in 2022 during that bear market was about a 1,200 point sell-off in the S&P 500. COVID 2020 sell-off was about a 1,200 point sell-off in the S&P 500. And when you add that 1,200 points to the prior resistance level, you actually get the targets that have played out, almost to a penny. They've played out really well, and that next target is about 7,000 to 7,200.
What kind of a ride are we going to have to get there? Because, of course, this year we've seen significantly heightened volatility. We do have all those headline risks out there. So are we in for a bumpy ride? Or once this market is sure that the tariffs and the headline risks aren't going to become too bad, is it off to the races?
It'll probably be a steady grind up, two steps forward, one step back. I'm sure we'll see plenty of 3 to 5% corrections in the meantime when we get these headline risks, which, are not going to stop happening. But, I don't think we're going to get a drastic, we already did a lot of the technical damage that needed to be done in order for the market to grind higher. And that was a near 20% sell off earlier this year. So I feel like after that much damage, with enough time of us kind of going sideways and consolidating these recent gains, the path of least resistance is going to be higher, no doubt in my mind.
Let's talk a little bit about breadth, because as you pointed out, you really love AI as a driver for a lot of this. AI puts us back in some stocks that have been very popular, not entirely just in those stocks, but obviously things that have been driving. Will we see breadth in this market, or are we going back to a few companies leading the way?
Yeah, the AI trade was definitely reignited in the past few weeks, and that's where we've seen a lot of the gains concentrated. But I think as time goes on, as people start understanding that, companies in the industrial sector, in the consumer staples, financials, all these companies are adopting AI tech, and it's just going to make them that more efficient. So I think the rally does have the chance to be more broad based than it was in early 2023 when it was just the mega cap, the Magnificent Seven driving the rally.
You brought up fundamentals, and I should point out that while we do have some guests in Talking Technicals who really focus entirely on the technicals, you look at both sharply. And obviously, you're believing that the fundamentals support the technicals here and the technicals support the fundamentals. But as you are sizing up both, is this more momentum driven or is this more fundamental driven to you?
That's a great question. And I feel like this is a cop-out answer, but right now it really feels like a 50-50 split. That's kind of how I approach my work, is 50% on the technicals, 50% on the fundamentals. So I am a split guy, but the charts are so strong. I see so many cup and handle patterns on the verge of breakouts. And then I see, tech companies reporting earnings with growth in the double digits a lot higher. So it seems like we're in this sweet spot when the charts are lining up perfectly as the fundamentals are improving. And that can lead to some explosive moves. I've seen it in 2013, which was a great year for the market. That's kind of reminiscent of that. So, I am worried to come off as too bullish, but I think it's hard not to be pretty constructive on the market going forward.
What about the Fed in all of this? Because you haven't mentioned it. Does the Fed need to do anything to encourage this rally that you're seeing? Or are you worried at all that the Fed's actions could discourage it? Or if the Fed takes its course, which looks like it's not going to be doing any moves for a while, that's okay. That doesn't really impact what you're seeing.
Yeah, I'd say no impact from the Fed in any direction. I think the best case scenario for bullish investors in the stock market is that the Fed does nothing and just keeps interest rates unchanged, because that would just signal that the economy is still on solid footing, companies are still growing their profits and all that good stuff. But, if inflation does keep, declining, and we could get a couple interest rate cuts from the Fed too, that wouldn't hurt. That would probably just be a nice little added boost. And one last thing technically I got to think of is we still haven't even seen a golden cross in the S&P 500 yet, right? We saw the death cross back in mid-April, right around the bottom, and the golden cross is still probably a couple of weeks away. Just think of all the bullish articles online that's going to generate, all the increased sentiment that's going to drive. So I just think that there's plenty of buying power ahead for the market.
Well, I love good news when we get it, and this certainly sounds like good news. Matt, thanks so much for joining me on the show to talk about it. We'll talk to you again on the line and see if you being at the very optimistic end of the things pays off.
Yeah, hey, hold me accountable. I'll be back no matter what happens. Thanks so much for having me, Chuck.
That's Matt Fox. He's the founder and president at Ithaca Wealth Management. It's ithacawealth.com. By the way, he's on X at Top Stock Charts if you're looking for him there. We are just getting started on the June 17th edition of Money Life. We've got much more to go. Next, we're going to be talking about what a survey said, and then Paul Christopher from the Wells Fargo Investment Institute here for the big interview. This is Money Life.
Everything an advisor needs can be found in one award-winning newsletter. Advisor Perspectives takes the most important financial perspectives and delivers it right to your inbox. Go to advisorperspectives.com and stay informed.
Now Money Life looks at what the survey said. Yes, this is the survey said on Money Life. It's where we dig into surveys, studies, polls, any kind of research or data that's going to help us understand what people are doing for, with, and about their money. And today, it's not entirely about your money. It is about your home.
There's no place like home.
And while there's no place like home, people are being a lot more selective about the places that they are calling home, because there's new research out from Clever Real Estate on how long it is taking for houses to sell. And I can tell you, as somebody who is living in a town that doesn't normally have things that stay on the market for long, in a neighborhood that would be pretty hot, I've got a house that every time I drive out of my own neighborhood, we look and go, wow, I can't remember something being on the market this long without getting a sale. And of course, there can be a lot of reasons for that, but it is distinctly something I've seen in my neighborhood, and we're seeing it in a lot of other places. If you want to check it out for yourself, you're going to go to listwithclever.com, but we can get you directly there. You can follow a link in our show notes or on our guest page where you find my guest, Drake Shadwell. He's an analyst at Clever Real Estate. And again, find him to get directly to their research on how long it's taking to sell a house. Drake Shadwell, welcome to Money Life.
Thanks for having me. Good to be here. Excited to talk about some data.
Yeah. And the data in this case, it's important because we've seen a housing market that for a long time had gotten very hot because, we keep hearing there's not much of a supply out there and what have you. Is what we are seeing here, well, A, let's talk about the numbers and what's happening to the average number of days to sell a house. And then B, what's causing the changes that you're seeing?
Yeah, I think this is important for people to be paying attention to, because we had such a long period where the market was so hot and it was moving so quickly. So transactions were up, and the time that people were spending on the market, it started to feel more and more like houses were selling like stocks. We've always viewed homes as investments, but it was always a longer investment. It was more it was going to take you longer to liquidate. And now we're starting to get back into that pattern of your home is not a stock. It is something that will be sold. It will take some time. It takes some intention, some thought. It depends upon where you are. Everything is always local. That's why we always encourage people to talk to someone that's local, that's an expert. But, looking at the data overall, we can definitely see there's a change, that things are getting back to, you do have to be more intentional. You do have to be more patient if you're looking to get that full price on the property. So I think it is important for people to be, keeping an eye on it.
With the change, with things taking a little bit longer, is it not just what's happening in terms of how long it's taking, but is it also that the value of the deals is maybe coming down a little bit, or the value of the perks? Like, I think about my neighborhood where I say I'm driving by this house all the time. And it's important because they're a very good comp for my home. And my wife and I are considering, are we going to stay? What might we do? There's something really important in that, which is in this neighborhood, in this town, when the market gets hot, deals go through without contingencies. It's like, oh, we'll waive the inspection. We'll do whatever. We're ready to buy. We'll pay, the asking price or whatever, or we'll do it without any fear that your roof needs to be redone or whatever it might be. And now, well, as things slow down, what I'm hearing from my friends who are agents is, oh no, all of the contingencies have come back in. So is this impacting that kind of activity as well?
Absolutely. I was an agent during that hot time where it was hard to convince my clients, no, no, please keep these contingencies in, because they were so nervous that someone was going to come in and just come in with cash, $10,000 over asking, and close very quickly. People now have the luxury of, I'm going to take my time. I'm going to look at, I'm going to have my inspection. I'm going to have my financing contingency, and they're able to be a little bit more discerning. It's not, I wouldn't say it's fully, shifted all the way back to a buyer's market. And once again, it's very local. So what you're doing is probably the smartest, not to stroke your ego too much here, but what you're doing is right. It's look at what houses around you are doing, because if you want to sell your property super fast, you can price it $10,000 below the market, but nobody wants to leave $10,000 on the table. So the key is, okay, look at what houses around you are selling for, and look, you can see how long in your neighborhood, in your area, did it take for a property to sell at its current price. That's what's really cool about our current market and our current, in the current transparency of data, I'll say, is you can be very local. What's nice about something like a place like Clever is it is able to give you a very good idea of, hey, what is the nationwide, what's happening, what is a little bit more local, because we do separate our groups of data, and we're able to do data that is local and regional. We're able to do it on a larger scale, and that gives you a directional idea. And then you take those insights into your negotiations when you're looking to buy or sell. So yeah, I think that's a huge part of it, is being more comfortable. I can put a contingency in here, but if you're in one of those neighborhoods that you see a property go up and it's gone in a second, then you might still be in those situations where you have to make the decision, am I comfortable without contingencies? So I think, yeah, it's all about being aware and taking the same type of approach that we take with our data, and looking at very specifically, where are you looking to buy and where are you looking to sell.
How much variance did you find in the numbers? Like, as we're saying, okay, it's now closer to 86 days that a house is on the market. And oh, by the way, is that 86 days from when it goes on the market to when it closes? Because, of course, it takes a little time to close, even if you sold the house in 5 minutes. But how much variance are we seeing? Like, obviously, there are some markets that are significantly hotter, some markets that are significantly colder, but this is a nationwide trend. Or is it skewed by the biggest markets the way the stock market is skewed by the Magnificent Seven?
That is a great question. So there is a wide level of variance. We're seeing that time range from like the high 50s to low 60s, all the way up to, I think the highest we found was somewhere around like in the 140s, 150s. So there is a wide variance, but that average, that 80 to 90, is a good place to start. And answering your question, we decided to go to close. So that includes your closing period. And like you said, you could have it under contract in a day or two, but you're still going to minimum be looking at, a 25, 30 days of an escrow period. Obviously that can change if you're dealing with cash or if you're dealing with, an investor basis and all you have to worry about is title. But for the most part, yeah, you're looking at, adding 30 days to your contract time.
Are we also seeing, okay, we've reached an agreement, but the post time changing a little bit because, everybody's trying to shop around for interest rates, and interest rates have stayed higher for longer?
That's a great question that I don't have. We haven't run surveys on the impact of interest rates and the escrow period. We are seeing a lot of people start to go with a higher interest is going into cash programs. So, Clever Offers is a subsection of Clever Real Estate. And we're seeing a lot more interest in that part of our business where people are asking, hey, do you have alternate options from going to the market? Because I do want a shorter escrow period. I do want to, go under contract quickly and sell quickly. So we're actually seeing a much higher uptick in people that have interest in that. So I think you're right. I think there is going to be a trend towards people at least exploring that option of, I might be willing to take a little bit of a hit on the purchase price if I just don't have to wait as long. And we're seeing more and more people go with that route.
I'm just curious because you're an analyst. This is not in the survey we're talking about, but was there a sense of our folks as part of the delay waiting because they're hoping they're going to get a rate cut? Because, we've got a president who's been pushing for one, although we've got a Fed that seems unlikely to cut for a while longer.
There was a long period where, anecdotally, we were hearing a lot of stories of, I'm not going to sell because I have a 3% interest rate. I have a 2 or a 3% interest rate. I'm going into a 6, maybe 7% interest rate. And all of a sudden, my home price, it might be $25,000 less, but my monthly payment is the same. And so all of a sudden, like per square foot, I'm not getting as much value because my money's going towards interest. And it's just a very interesting, it's a funny dichotomy of words there, but it's an interesting piece of our real estate market because it's so heavily towards locked in interest rate financing for home purchases. It's very rare for people to be buying with cash. That interest rate is a huge part of buying power, because like what people are really focused on, everyone wants to know, hey, what's my house worth? 350, 450, 400, 500. Everyone thinks about that number, but when you're actually buying, most people are interested in their monthly payment. Like most people are looking at what's my payday payment, what's my principal, insurance, taxes, and interest. And that is what they're using to buy. So if interest goes up, it doesn't matter if your principal, your actual price of your property is staying the same or even dropping, because they're not going to leave a 3% interest rate that reduces their payday payment as much as it does. So anecdotally, we did hear a lot of those stories. I'm going to be interested in looking at forward, seeing how much are we going to see change management where people start to get used to the idea that interest rates aren't coming down. And so that starts to become less and less of a factor. I think it will always be a factor, but I think as people get farther and farther away from those interest rates, we're going to see more and more people are comfortable with the current state of interest rates.
Yeah. Golden handcuffs is what a 3% mortgage is. It's going to keep you in the house for a very long time. But I'm old enough to remember when my parents refinanced their house to be able to get their mortgage under double digits. So, there's complaint levels and we didn't have it the worst then. We're not having it the worst now. Drake, great stuff. Thank you so much for joining me on the show to talk about it.
Absolutely. Thanks for having me. Happy to come back anytime.
That's Drake Shadwell. He's an analyst at Clever Real Estate. Listwithclever.com is the website. If you're looking for more information, there's the direct link that gets you to their details on how long it takes to sell a house. We're not going to sell anything here on Money Life. We're going to take a break, but then we'll be right back to the action. So stick around because we are living the money life and we're back at it in a flash.
Asset managers, you know how hard it is to stand out in this crowded space. Vetify is a unique partner that can help you across the entire product lifecycle. With a best-in-class index factory and an award-winning digital marketing team, Vetify can help you build the products of your dreams, optimize your distribution efforts, and grow your assets under management. Learn more at Vetify.com.
Welcome to the big interview on the June 17th edition of Money Life. Returning to the show today, Paul Christopher, head of global investment strategy at Wells Fargo Investment Institute. And if you want to learn more about what they do there, if you want to see their commentaries, or perhaps most importantly, their outlook, because they recently issued their June 2025 outlook, go to investmentinstitute.wf.com. Paul Christopher, welcome back to Money Life.
Thank you very much, Chuck. Great to be back.
Let's start with the outlook and a simple question that I know will almost certainly lead to a complicated answer, which is if we only look at what we've seen in the first half of the year as where we started and where we are now, well, we have a market that's up a little bit and we take most of the volatility and most of the scare out. But how different is the June outlook for what's happening in the second half of the year from the outlook that you had entering the year? Because the market results aren't necessarily all that off the prediction, but the way we got from there to here certainly was.
Yeah, absolutely. We didn't expect that long detour through tariff land at the beginning of April, and we don't think the tariffs and their shock are done yet. But probably the worst of it has passed.
So, what does that lead for the rest of the year? Now that we've recovered and we're up slightly, where are you on what happens next?
So where we are right now is sitting right on top of our 6,000 midpoint of the target range, 5,900 to 6,100 for the S&P at year end 25. And so clients and investors might be saying, well, shoot, well, why don't I just take my profits now? And in some cases, in some areas of the market, yeah, that might make some sense. But to liquidate the portfolio here, we think is a mistake. We do think tariffs will come back to bite in the third quarter. Consider, for instance, that the 90-day pause on those April 2 reciprocal tariffs, that pause ends on July the 9th. There's another pause on Chinese reciprocal tariffs, which were over 100%. And that pause ends on August the 12th. And in the meantime, you've got a budget bill with still unknown parameters in it that will increase deficits and give back some tax cuts, but we're not exactly sure which ones. So there's a whole lot of stuff going on between July the 9th and the middle of August. And I told my team, take your vacations now. We are expecting a pullback. There will be surprises. Some of them will be negative, and we think the S&P pulls back 5 to 10% easily from here. Not like back in April when tariffs were a surprise. This time they're not a surprise, but they will be coming, and they're going to generate inflation in the third quarter. That inflation then will slow the economy further into the end of the year before we start to pick up momentum again in 26. So there is some disconnect here between the prices that investors are paying today and the earnings growth that they're paying for. That earnings growth is slowing. It's going to slow further. The tariff surprises and the budget surprises will accentuate that. The war in the Middle East could do the same. And that's why here we're a little bit cautious with the market here at 6,000. We would want to trim some positions and maybe reallocate elsewhere.
The decline that you see coming, is it important to you that the market recapture highs before we have this? Or is it okay with you if the market kind of says, hey, we've rallied and now it's okay to take a setback before it establishes a new record?
What we're afraid of is that the more we rally here, the more people will be clamoring to get into a market that is going to turn around, and that those folks will then end up being some of the first to exit. And what that does is create an accelerant to the downside. In other words, the more people who pile in here at the very end of the rally, the more likely it is that the market, when it does turn, will fall furiously and fast. And so, could we retest those lows? It's a possibility, but it really depends on what combination of events get us there. If we get oil at $100 a barrel, yes, we could get down to 4,900, 5,000 on the S&P. If we get a budget deal with 8% deficits into the foreseeable future, yes, that could also do it. If we get tariffs that aren't much different from April, yes, that also could do it. But there's room for not such a bad scenario in all three of those cases going forward. And we just don't know where they're all policy decisions, right? They're all human government decisions. We don't know where any of those are going to land yet. So a 5 to 10% pullback, yeah, that should be reasonable, but you could get accelerants to the downside, and you could get some surprises on those policy decisions that could put us back down at that 4,900 level. We would still be buyers there, but I would hate to see people lose that 10 to 12%, 10 to 15% by buying here in the wrong areas.
Let's talk now about what you are buying and maybe what you're pulling back on, because what it sounds mostly like is let's get back to your target allocations. Let's take the run that we've had, rebalance, et cetera. Or is it more than that?
It's a little bit more than that, and it's a little bit more selective than that. And what we're trying to do here is say, well, look, who has the best prospects over the next 12 to 18 months? And if we look at the regional level, we think the U.S. does. We think the U.S. was oversold and the international markets were overbought. Europe, China, Japan, all of those were overbought. So we would be trimming positions there right now, taking those back down to strategic levels, yes. And then put that cash aside, and then we're going to wait for the S&P 500 to have its correction. And that's when we're going to start doing some serious buying. And what we want to buy are those, and forgive me, it's not hockey season or it's the tail end of hockey season, but we want offensive defensemen. You want a defenseman who can score goals. And then the S&P 500, that's going to be quality sectors with quality companies, and let me define that term. Quality means a company or a sector where the companies have good balance sheets, strength, not a lot of debt, good debt service, low debt service, good free cash flow. And we like the idea of companies that have good long-term themes. I noticed in the first quarter earnings reports that tech did pretty well. And in fact, it seemed to do well among industrial companies. What I mean is customers who are industrial companies to tech firms. Those industrial companies, what are they buying? They're buying software. They're buying servers. They're buying the automation means to get around the negative impact of tariffs. So if I'm looking for a company or a sector that we think has the ability to have some, not just inoculation against tariffs, but could actually do better the more the tariffs are, that would be tech and comm services on the S&P 500. We added utilities recently because we also like the AI theme, the artificial intelligence theme going forward. And so those data centers are going to need lots more power than is available right now in the grid. So we buy utilities here. So those are the sorts of things that we want to buy. And then the whole market may fall as this correction comes. That's where we want to buy a company whose price has gone down, maybe not as much as a materials company, maybe not as much as an industrials company, right? Our quality companies should cushion you a little bit on the bottom, on the way down, but those quality companies we think won't go down by as much, and we think they are better suited and better positioned to take advantage of the recovery that we expect in 26 and beyond. So tech and comm services, utilities, I mentioned those. We also like financials here. As the economy recovers, we think interest rates will rise. The Fed will cut rates into 26. That should favor financials. And we like energy here. It's helping out portfolios right now. We think energy is going to be an important source of the power for these utilities, that it's going to drive AI into the future. And so those are our picks right now. We're sticking with companies that have good balance sheets and that have good long-term prospects. They may sell off in the correction, but we don't think they'll sell off by as much, and we think they have better long-term prospects. So that's how we're seeing this going forward. We don't think you can avoid the hit, but we'll try to minimize it and then build a more resilient portfolio on the way back up.
Where are you going in terms of internationally versus domestic? How much are you tilting out and how much are you pulling back?
It really depends on the investor's long-term investment objectives. I mean, I could see someone with very aggressive in long-term objectives, a 30-year-old, for example, who doesn't care if there's a pullback in the next 10 years. I wouldn't necessarily say the same thing for a 65-year-old. So maybe an international portion is 25% of the equity portfolio. For an aggressive investor, but maybe it's only 10% for a less aggressive investor, a more conservative, income-oriented one who's older. So that wherever your sort of your comfort level is for the long term, that's what you want to go back to here in international. It might be 5 percentage points of your portfolio. It might be 10 to pull back on. I mean,
because you're already expecting a downturn. What are the wild cards that you are most worried about? Like, is it consumer spending? Is it what's happening in the Middle East? Is it what's happening in India? Is it the geopolitical stuff, or is it the fundamental stuff that worries you?
It's more the fundamental stuff. Whenever you're thinking about risks, you always want to think about the impact, the potential impact, and the potential probability. And so when I think of those things that you just ticked off, the ones with the combination of highest probability and highest potential impact start with the consumer. The consumer really hasn't seen the price increases that we're expecting to come out in the third quarter with tariffs. And when the consumers do see that, we expect them to rearrange their consumption. They might even, in shock, pull back on consumption at first, and that would be the slowing into the fourth quarter that we're expecting. But eventually, you put a tax on somebody, and that's what a tariff is. It's a tax. The U.S. consumer is sending money to the U.S. government. When you put a tax on somebody, the first thing they do is to try to find a way around it. And eventually consumers will make those adjustments. They'll find goods that aren't tariffed. They'll find the goods that are made domestically, or they'll buy more services. They'll get more into the experiential aspect of life instead of the goods aspect of life. But in the immediate term, in the next 6 months, it could be the consumer that's the number one concern here. They're going to drive the slowdown, we think. The other things are further down the list, not because the impacts are small, but because the probabilities are less certain or are smaller. For example, the budget. if you think about the budget, we do think there are going to be deficits. We also think that Congress will try to minimize those somewhat and will probably end up cutting some spending. That will cost political support, but it probably isn't as bad for the economy as it would be if we had the larger deficits. And then when you get to the Middle East, the impacts are potentially huge. Iran has submarines, drones. It has unmanned submersibles that they could attack tankers with. These are weapons that they didn't have 20, 30 years ago when we had problems in the Gulf. Can the U.S. and its allies stop them from doing that? And what would get Iran to do that in the first place? Well, it might be that the Israelis need a 20,000-pound bunker buster bomb that only the U.S. has, and finally the U.S. agrees to go in and bust some bunkers, and then the Iranians respond with an attack on tankers in the Gulf, and then you get $100 oil, and all bets are off. Well, what are the odds of that? Right now, who knows? The Iranians and the Israelis are being very restrained. Could they get unrestrained? Well, yes, they could. We just don't have any way to predict what the probability is on that. So I'm going to put that further down the list. It's a big impact, but it's just not as well understood because it's people fighting each other, not predictable.
Let's talk for a second about gold and other commodities. Are you lumping gold in with other assets, or is it a standalone? And B, given everything else that's going on, particularly with oil, how are you treating commodities investments, and how much of a portfolio, given everything that you like and where you see opportunities at, do you want this to be?
Yeah, thank you for asking that question, because I should have addressed that as I closed my final answer, the last one. I don't want to scare people here. I mean, investing is always risky. There are always things that could happen that have low probabilities to them. We dealt with that throughout the Cold War, right? And nuclear annihilation, that was a risk, but a low probability. So investors need to get used to those kinds of risks, but you can hedge them. And now to circle back to your question on commodities, yes, we do lump gold and oil in with ag, grains, for example, and base metals like in aluminum and copper and zinc. We put all of those together into a commodity basket, and we would hold maybe 4, 5, 6% of the total portfolio. Again, depending upon the investor's risk level, right? The more aggressive you want to be, the higher your hedge. The less aggressive you want to be overall, then the lower your hedge needs to be, because you're already going to have more fixed income. But for anyone who wants to hedge, and we do recommend it to some degree for everyone, a full basket of commodities we think is the way to go. You're going to have some gold in there. You're going to have some platinum. You're going to have some oil, but you're also going to have some natural gas for the long run. Natural gas is going to be very important as these data centers get up and running, because that's what's going to power the utilities that serve them to create the electricity. So you want the full energy complex. You want the full precious metals complex. And we might see tariffs coming on base metals, and that's going to drive those prices up. Aluminum, copper, zinc. We don't know what combinations those are going to look like. So that hedge that I was mentioning against some of these risks that have large impacts, but potentially low or maybe just uncalculable probabilities, hedging with some commodities is the way to go. And a 200 or 300 basis point or 2 or 3 percentage point allocation over and above what you would ordinarily hold, your strategic levels, that's a good hedge, we think, here.
We've come this far in the conversation, and we have not discussed the Fed. What's your take on rate cuts, and when?
Yeah, so think about the sequence we talked about. The tariffs arrived this summer. Deals or no deals, they're going to be tariffs. They start to filter their way into consumer prices. Consumers notice them maybe August, September, October, and that's when consumers have that reaction that, whoa, we talked about this in April, but here they are now, so I've got to react. You're going to see some slowdown in spending. You're going to see some spending go into more domestic goods, but mainly a slowdown in spending into the fourth quarter. That's what the Fed needs to see. It needs to see the inflation from the tax hike start to dissipate, because inflation from tax hikes is a one-off. Raise the price once for the tax, and that's it. As the inflation starts to dissipate into November and December and the economy is slowed, that gives the Fed a window to cut. And maybe 125 or quarter point cut, maybe one of those in November and December, and then maybe another one as we get into 26. But then the economy, we think, starts to recover and the Fed's window closes. So the Fed here is probably a smaller factor than we're used to seeing, especially in recent years, a smaller factor for markets, but they should be a positively contributing one for investors. A quarter point this year, maybe another quarter point next year, that helps. It doesn't solve the problem of tariffs.
We talked briefly about some of the political things, and certainly the tariffs got there, but we have a budget bill going through Congress or trying to go through Congress. How much are you worried that given the gridlock that we have, it doesn't get through and it sets us up for another fiscal cliff and all the rest? Or is that something you won't worry about until it gets here?
Well, it's always a possibility, a fiscal cliff, especially because we have a debt ceiling that has to be addressed by early August, or the Treasury is going to be very low on cash at that point. And Congress doesn't want to go into the midterm year, the campaign season, with that sort of egg on its face. So we do think that extending the 2017 tax cuts will be a big deal for them. That will be priority number one, and we think that will happen. We also foresee that some of the tax cuts that have from that 2017 law that have already lapsed, we think those will be reinstated, like the tax benefit for research and development, especially for small companies. That will be brought back in with the several others that have fallen off. That will be a positive for the markets going forward. We might see some further action from Congress to cut taxes on overtime, tips, and Social Security. The question will be how to pay for those things. And that's where the spending cuts come in. And we will see quite a lot of argument over that. But we think ultimately Congress will raise the debt ceiling. They will increase the deficit. So the debt ceiling will have to go up by more than it would have otherwise. And they will pass those tax cut extensions. And it will probably happen by the end of July. Will the bond market get a little nervous? Yeah, if it goes to the 11th hour and the 59th minute. But we think equity markets are fully discounting already that those tax cuts will be extended.
And last question. You and I typically talk once or twice a year, but Wells Fargo Investment Institute puts out regular updates and outlooks. So as you put on the longest lens you've got and you think about what you're going to be facing when you do your 2026 outlook, doesn't sound like you've got recession in your forecast. Doesn't sound like there's long-lasting trouble. I don't think people mind necessarily a downturn. They just mind a downturn that stays. But is the biggest trouble coming in 2027?
It's always hard to predict the geopolitical stuff, as I've mentioned a couple of times now. The probabilities on things like, well, how long will the Iran or Israel war last, and what will be the ultimate damage done? Will there be regime change? Will Iran kick out the mullahs and put in somebody who's even more extreme? I just don't know the answers to those questions. I'm more interested in questions like, what will happen with these tariffs after a while? If we don't see the industries come back to the U.S., and I don't think they will, in these heavy industries that employed labor workers, I don't think you're going to see a lot of union jobs come back. You're going to see more automation instead. So the question then becomes, what happens to the overall economy? How does it manage in the face of these headwinds from the tariffs if they remain in place? And all of economic thought tells us that the longer you leave tariffs in place, the more your consumers suffer. And so we would expect the economy to maybe have a lower ceiling of growth going forward. And how will companies adjust to that? They've been very good, companies have, in leveraging their operations. What I mean by that is in 22, we saw prices go way, way up, but companies figured out a way to make profits anyway, even though their costs were going up. That's operational leverage. Can companies increase that operational leverage to maintain profit margins well enough to drive the market to 7,000 on the S&P, 8,000 on the S&P? We think the market can, but we'll have to see how bad those tariffs, how heavy those tariffs are. In other words, how strong the headwind is for those companies going forward. That's the key question as we move more towards the end of 26.
I actually said that was the last question, but I'm going to squeeze one more in. How much do you worry about the consumer being exhausted by all this?
There's always the way we've been describing it is the business cycles that we've seen are not like the ones that we grew up with. Well, okay, maybe some of us grew up with in the 70s, right, where you have strong growth followed by inflation, then a sharp crash. What we're going to see more of, we think, are these sort of very smooth cycles where you have a little bit of a dip and then you recover. And the real reason for that is monetary policy. As long as the Fed is willing to increase the size of its balance sheet, which necessarily increases the cash in the economy, right? Liabilities equal assets. If you increase your assets, you increase your liabilities, which is cash. The Fed floods the economy with money. Consumers will find a way. They will just find a way. And so the up and the down will be much more tame than they were in previous decades. And I think what we're seeing now is exactly that. Some consumers are already topped out on their credit cards. But what are they doing? Well, they're using some leverage from their homes in limited cases, but mainly their earnings are growing. Earnings are growing close to 4% a year. Inflation is right around 3%. So over the long term, that gives consumers more purchasing power over time. So they can afford to pay off a little bit of their credit card each month and then put that debt back on the credit card. In other words, create a little space for themselves and then use it up, and then create more space and then use it up. And so they don't have to go through periods where they go through spending shock, where they're not spending anything. That's what drives the big unemployment and the big crashes that we saw in the past, like the early 80s. We might see more recessions like we did in 1991, which were very mild, as long as the Fed is willing and able to expand its balance sheet the way it has since 2008.
Somehow it always comes back around to the Fed. I'm sure it will come back around to the Fed the next time you were talking. Meanwhile, thanks so much for the conversation today. Paul, great stuff. Thanks for joining me on the show.
Thank you, Chuck. Always a pleasure.
That's Paul Christopher, the head of global investment strategy at the Wells Fargo Investment Institute. Investmentinstitute.wf.com. We've got a direct link in our show notes to their outlook, their mid-year 2025 outlook, and more. And we will be back to wrap up today's edition of Money Life right after this message. Stick with me till the end. Back to wrap this one up. Really interesting show. I mean, that dichotomy between Paul Christopher talking about how he expects a setback and how he is thinking things will be tough sledding, and Matt Fox going, I'm looking at the technicals and the fundamentals, and I see S&P 7,000. And again, disagreement makes a market. You are in the middle of it. You have to decide which way you want to go. And you could lean in to either one, or if you split the difference, you're actually going to side maybe a little bit more with Paul because you would be more diversified. Paul's message, pretty similar to what you heard a day ago from Brent Schutte. Matt's message, very different, very different. So again, we're not trying to give you answers. We're not trying to give you something where you go, that's my soundbite. I'm going to hold fast to that one. Now, it may happen at times. You may hear someone say something and go, that is exactly how I feel. And there's nothing wrong with that either. It's just we want to make sure that while you say, okay, that's what I feel, you're still listening to the others. This is not about let's have just one way of thinking. Hear the others, then decide how you feel. Speaking of others, man, great stuff coming because we've added this week Brian Levitt, global market strategist at Invesco. He will be here on Friday's show. So remember, there's no show on Thursday because it is the Juneteenth holiday. But tomorrow, Julia Herman, global market strategist for New York Life Investments, co-host of their Market Matters podcast. She is spectacular. She will be here. She's a great guest. The one time she was on, I was like, wow, what a great interview. I'm hoping we have that experience again. But Brian Levitt from Invesco returns here on Friday. Also coming this week, Jeff Crumpelman, Chief Investment Strategist at Mariner Wealth Advisors. He will be here talking technicals on Friday, so we'll get a good counterpoint. On tomorrow's show, we also have Greg McBride, Chief Financial Analyst at Bankrate.com. We'll do a little preview of the Fed and rate cuts or potential rate cuts. Plan to be here, except for Thursday when we won't be here. But, of course, if you've got shows to catch up on, you can do that on Thursday. And I know Thursday's like an odd holiday for folks. For me, too, because most holidays – now, on Money Left, we have to produce a show for Friday, so we could produce that on Wednesday or we could produce that on Thursday. But it's very common for us to be working on a holiday because we still have things to produce. But Thursday was very odd because when you sort of set it in there and you're getting the calendar things and you're inviting people, You have to remember to pull it out. So people had said, oh, yeah, no, I'd love to talk on Thursday because I'm going to be in the office and everybody else is not going to be. So we'll do a little bit of work at least on Thursday. If you're not looking to work and you're looking for something to celebrate today, well, it is National Mascot Day. You know, we don't have a mascot here on Money Life. I don't know what the mascot would be, like a giant talking, walking dollar bill or something. That'd be interesting. We should think about that. It is, everything else is food related. It is National Eat Your Vegetables Day. It is National Root Beer Day, which is also known as Stewart's Root Beer Day. When I was growing up in New Jersey, there was a Stewart's Root Beer that was kind of at the like town line with the next town over. I'm not a big root beer guy, but I love their orange soda and the Stewart's stand. Man, great as like quasi fast food. Awesome. It's also National Apple Strudel Day and National Cherry Tart Day. And I'm going to tell you that if you like making cherry tarts or cherry pies, I get supplies because I make 2 cherry pies for Gail every year. I get my supplies from a place in Michigan. Oh, by the way, has its biggest sale, which is basically amounts to free shipping because it's not cheap stuff, every June. So that is going on now, but you can check it out for yourself at spoon.com. I wholeheartedly recommend it. Amazing stuff. Their sour cherry preserves, if you're into cherries, are just wild. And my mom is the one who got me hooked. So I have extra reason to think of it because every time I'm using their stuff, I'm thinking of it a little bit about my mom. Now let's think about our guests. They were Matt Fox, president at Ithaca Wealth Management, ithacawealth.com. Drake Shadwell, analyst at Clever Real Estate, listwithclever.com. And Paul Christopher, head of global investment strategy for the Wells Fargo Investment Institute. Apparently, the web address I gave for them was not quite right. You'll find the institute through wellsfargoadvisors.com. Better yet, use the direct link that's in our show notes because that will get you straight off to not just the Investment Institute, but all of their investment and research analysis. Thanks to them. Thanks to Rob Floyd, my producer. Thanks, of course, to Maho, my dog. But mostly thanks to you for being here because you make this special and worthwhile for me each and every day. The Money Life quote of the day comes from Max Plowman, who said, money is a dangerous subject. Polite conversation avoids it. You may talk about economics, but not raw money. Well, we do talk more about economics than raw money, but we do not avoid it in conversation. And we know that you shouldn't because you have to keep it in perspective. And perspective, that means remembering that until we do this again the next time, the best thing you could do for your money is not worry too much about it. Have a great day, everybody. Stay safe and calm. We'll see you here again tomorrow.
The people who appear on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.
Well, friends, like all great things, this too must end.